A recession is looming on the horizon, casting a shadow of uncertainty over the financial world. While many fear this impending economic slowdown, the savvy few see it as an opportunity to turn the tide and achieve financial success. I'm not talking about just surviving the recession. I'm talking about thriving and even getting rich. You see, while the average investor might panic and retreat to their safety blankets, the rich guys know that recessions are when real wealth is created. They understand that chaos breeds opportunities, and they're ready to seize them. And you can too. In this video, I'll unveil the 5 game-changing strategies that the rich guys are using to win the recession game. These are the same strategies that have allowed them to amass incredible wealth, even during the most turbulent times. Imagine being able to protect your assets from the ravages of inflation and market downturns. Identify the sectors that are poised to explode during the recession. Make strategic investments that will yield massive returns. Sounds too good to be true? Well, it's not. I'll share real-world examples of how these strategies have worked for others, proving that getting rich during a recession is not just a dream, but a realistic possibility. Are you ready to turn the tables on the recession and become a part of the elite group of winners? Join me on this journey as I reveal the secrets of the rich guys and show you how you can join them in their pursuit of financial independence. Don't let the recession hold you back. Take control of your finances and start building your wealth today. Click the subscribe button and hit the notification bell so you don't miss a single detail of these game-changing strategies. Together, we'll turn the recession into our golden opportunity. 1. Stocks. When the stock market takes a dip, it's actually a plus for me, since I'm someone who buys more stocks than sells them. I've been doing this since I was 14, so when stocks drop, it's like a sale to me, similar to when prices drop for things I regularly buy, like hamburgers or Coca-Cola. But there's some big news on the job front. Reports suggest the US might be looking at losing around 97,000 jobs per month, which is a substantial figure. It's bound to have an impact on your investments. Looking at today's stock market, the major players and indexes have taken a hit of about 10 to 20%. Some experts, like JP Morgan, suggest we could see more drops from here. But honestly, this isn't too surprising. Looking back, since 1946, when things got rough or during what's called bear markets, the average drop is around 30%. The worst hit was in 2009 when the S&P 500 fell by a whopping 57%. But if we add a recession to the mix, things get even more unstable. When the market goes down by about 34.8%, people start freaking out and sell their stocks. But here's the interesting part. That's when things begin to get better. If you look at how the S&P 500 has done over time, you'll see something neat. Every time the market crashes, it bounces back even stronger. So, what does this mean for you? Even when things are tough, there are smart moves you can make to grow your money. In the coming months, the market will go through some intriguing changes, offering an opportunity to make savvy investment decisions. This is your chance to pave the way for significant long-term profits. By making informed moves, you have the potential to emerge from this economic shift in a much stronger financial position than before. Stay focused and seize these opportunities to make prudent investment choices. David Tepper is a really rich guy in America who manages a big money company called Appaloosa Management and owns a football team, the Carolina Panthers. According to Forbes in April 2021, he's worth about $14.5 billion. That's a lot of money. He got super rich by making smart moves after the 2008 money mess-up. He bought cheap stocks from struggling banks like Bank of America and Citigroup, thinking the government wouldn't let them fail. He also put money into industries that were hurting a lot from the mess, like airlines, car makers, and energy companies. This smart thinking paid off big time. When the stock market got better, his investments made tons of money. In 2009, he made $4 billion, making him the richest money manager that year. And he kept making loads of money in the years after. $2.5 billion in 2010, $2.2 billion in 2012, and $3.5 billion in 2013. 2. Real estate. While the prospect of declining home prices may seem daunting, it's important to remember that real estate has historically proven to be a resilient asset class. Imagine the real estate market as a puzzle, where each piece represents a different property or market section. When the economy changes, these puzzle pieces shift, bringing new chances and difficulties. The trick is to find the spots that promise growth and strength. Looking ahead to the next year, experts predict a possible drop in housing prices, maybe around 5 to 10%. But remember, real estate varies by location. Some areas might see bigger price changes than others. Homeowners with fixed-rate mortgages and long-term goals might not feel much effect from these changes. But for investors and those looking to buy a home, this could be a great chance to find good deals. In this time of economic change, the real estate market offers challenges and chances. John Paulson managed a company called Paulson & Company, focusing on specific types of investing, like merger arbitrage and distressed debt. Around 2006, he grew worried about the housing market and the subprime mortgages being given out. He thought a lot of these mortgages would fail, and the securities tied to them were valued too high. To bet against this, Paulson used contracts called credit default swaps, CDS, that pay out if a bond fails. He targeted the ABX index, linked to 20 bonds made up of these risky mortgages. Paulson set up two funds, the Paulson Credit Opportunities Fund and the Paulson Advantage Plus Fund, to carry out this plan. Although he got money from other people, many of them were unsure or hesitant about his strategy. His bet worked out well in 2007 and 2008 when the housing market crashed and those subprime mortgage bonds lost a lot of value. Paulson & Company raked in about $15 billion in 2007 and another $5 billion in 2008, becoming one of the most successful hedge funds ever. Paulson himself earned somewhere between $3 billion and $4 billion in 2007, making him one of the wealthiest and most well-known investors globally. Some media and experts later called Paulson's move the greatest trade ever. It even became the focus of various books and articles. People who really get how the market works and have a smart plan can take advantage of these new opportunities. Let's stay focused, adapt to these changes, and make smart choices that set us up for success down the road. 3. Diversifying your investments in uncertain times. When economic uncertainty looms, safeguarding your money becomes a top priority. While the allure of high-growth investments might be tempting, diversifying your portfolio is crucial for long-term financial stability. This involves allocating your funds across various asset classes, including cash, gold, and long-term investments. Such diversification helps mitigate risks and protect your finances during unpredictable economic periods. The roles of each asset class. Cash. Your financial lifeline cash serves as a financial lifeline during economic uncertainties. It provides readily available funds to cover unexpected expenses, such as job loss or medical emergencies. Additionally, cash allows you to seize attractive investment opportunities that may arise during market downturns. Imagine a market downturn leads to a significant drop in stock prices. With cash reserves, you can take advantage of this opportunity to purchase stocks at a discounted price, potentially boosting your portfolio's long-term growth potential. Gold. A hedge against volatility. Gold has historically demonstrated its worth as a hedge against inflation and economic turmoil. Its value tends to rise when stocks and bonds falter, offering stability amidst market volatility. However, remember that gold is not a growth asset and should be considered a complementary component of a diversified portfolio. During the 2008 financial crisis, gold prices surged while stock and bond markets experienced significant losses. Investors who held gold in their portfolios benefited from this stability, protecting their wealth from the overall market downturn. Long-term investments, driving wealth creation. While cash and gold provide stability, long-term investments, such as stocks and bonds, are the engines that fuel wealth creation over time. These investments offer the potential for significant returns, but they also come with higher risk. Investing in a diversified portfolio of stocks and bonds over the long term has historically led to substantial wealth accumulation. For instance, A hypothetical investment of $10,000 in the S&P 500 index in 1970 would have grown to over $1 million by 2022. When there's talk of a recession looming, it's normal to feel uneasy about your investments. But this time can actually help us lock in our financial future by sticking to two important strategies: long-term investing and diversifying what you invest in. First off, don't change how you invest just because things seem shaky. Keep doing what you normally do. It's a bit like watering your garden regularly. If you keep buying shares every month, some months they'll cost less, some more, but in the long run, it balances out. This steady approach is called dollar cost averaging. Investing in a tech company can be a bit like buying shares of a roller coaster. One month they're at $50 and the next, they drop to $40. But if you keep buying during these ups and downs, your average cost per share goes down, setting you up for bigger gains when the prices go up again. Now, about diversification. Some folks say it doesn't make much sense if you know what you're doing. They call it a shield against not knowing what's what. Essentially, if you want to make sure nothing bad happens to your money compared to the market, you'd own a bit of everything. That's not a bad plan if you're not confident in picking specific businesses. For instance, if you put all your cash into just US tech stocks and they take a nosedive, it could be rough. But if you mix it up, throw in some international stocks, maybe some real estate, you spread out the risk. Imagine you've invested in a tech company's shares and also own some farmland. If the tech company's shares take a hit while the farmland value remains stable, you won't be hit hard across the board. This is an ideal time to increase your efforts at work or kickstart a side project. It demands extra dedication, but it's an opportunity for your wealth to flourish. For instance, if you're skilled in programming, consider taking on freelance projects. Or if you have a knack for crafting, sell your handmade items online. The additional earnings can be directed into your investments. Yes, weathering a recession is challenging, but the upcoming one is teeming with opportunities to expand your wealth. Stay consistent with your investments, even if the returns aren't immediate. Diversify your investments to minimize potential losses and put in that extra effort. It will pay off. When the market rebounds, as it usually does, you'll find yourself in a much stronger financial position. Don't forget to subscribe to my channel. Happy investing!